Good morning, dear students. Hope you are all doing well and have gone through the links shared so far. So far, we have already covered most of the key topics from units 4 and 5 in the last 4 lectures. In the last lecture, I mentioned that I will be sharing a document with a few question and answer. I am sharing that today and will be discussing the same. So, opening the document, the first question is related to trading process in a commodity exchange. This is something that we discussed in lecture 3. So the answer, an elaborate answer to that particular topic is given here. So you may read this. Moving on, the second question is related to settlement procedure. Please understand, students, this is also covered as part of trading procedure, more at a high level. In case this is asked as a specific question, you can use the contents of what I've given here. See, the key here is to understand what is debited or credited to the trader's account at the end of the day. That is, what is the settlement mechanism, right? So this is based on the following. If the trade was initiated today, it will be the difference between the entry value or trade price and the day's settlement price. Okay. If the trade, it's a continuous trade, it's a brought forward contract, that is, you have entered into trade probably sometime back. Okay, in such a case, what will be debited or credited will be the difference between the previous day's settlement price, that is end of the day price for previous day, and today's settlement price, that is today's end of the day price. The difference between the two will be credited or debited from the trader's account. And then on the same day, if you are entering into a contract and also closing it, it is the difference between the entry value and exit value for the day. As simple as that. And finally, on the day when the contract is actually closing, that is squaring off of positions, it is the difference between exit value and the previous day's settlement value. Okay. So this is what you need to understand, and you can look at the answer to elaborate a little more when it is asked as a specific question in exam. Now moving on, question number 3, this talks about a concept called market efficiency. So I haven't seen this being asked in any of the previous papers that I've seen. However, this has been included in your syllabus, so I'm covering this. So market efficiency is basically concerned with the precision with which the market prices the securities. Basically, as per this theory, for a market to be efficient, prices of securities, that is prices of your commodities or your shares, should reflect all the information that is available for the security or the commodity. Okay. So, it also believes that there should be a large number of informed and rational participants, as this makes the market liquid. And they also feel in an efficient market, security prices constantly keep adjusting themselves to new information that is generated. So that is why we say security prices are highly volatile and commodity markets are really volatile. I mean, they talk about a lockdown and all of a sudden see so many people rushing to shops. So the prices become highly volatile because the demand goes up, the prices also go up. So the price of the commodity reflect the mood, the temperament of all the information that is available. So that is what market efficiency claims. So this is what it should include. This concept was proposed by one Mr. Eugene Fama in the year 1970, and this theory that he brought out is called efficient market hypothesis. So these are some of the pointers of EMH or efficient market hypothesis. The efficient market hypothesis says that all known information about investment securities such as stocks is already factored into the prices of those securities. Therefore, assuming this is true, no amount of analysis can give an investor an edge over other investors. Okay, because everybody has access to same information, has uh, you know same amount of information also. So nobody has an edge over the other. This theory also says that individual investors sometimes may act randomly, but on the whole, the market is always right. I mean, they will go in a similar direction. So, if a crowd suddenly starts running in one direction, it's normal that others also start following that. So, that is what this philosophy says. Further, this particular hypothesis, that is efficient market hypothesis, spoke about three different forms of EMH, that is three forms of efficient market hypothesis: the weak form, the semi-strong form, and the strong form. In the weak form, it suggests that all past information about the commodity is priced in the commodity or the security. So, with this information, there are investors who might analyze and probably get a temporary edge over others in terms of better returns. But in the long run, this really doesn't happen. That is what they are saying. So the weak form basically talks about past information which affects the pricing of securities. Now the semi-strong form says that any new information is instantaneously added into the securities. I mean, they immediately react, or they are volatile to any new information regarding the security. So again, with this, the investors don't get any particular help. I mean, they don't get an edge using this in the long run. And finally, the strong form of EMH, it says that all information, I mean past, present, and whatever is forecast, both in public and private domain, is priced into the stocks. Okay, and no investor has a particular advantage in comparison to others. However, it says it doesn't imply that there are people who beat market averages and earn a better rate. And it also acknowledges the fact that there are people who also land up dramatically losing in the market. But as for this theory, it's purely because people who lose out are purely unlucky, and people who gain are people who are lucky. For the majority of the people, they are at an average level. Okay, so this is the concept of market efficiency and efficient market hypothesis. Moving on, the fourth question talks about the current scenario of commodity markets in India. So, see, the commodity markets in India, especially the agricultural commodities, it is believed is on the brink of a huge transformation, huge positive transformation. So, to discuss the situation so far, see, despite having extremely advanced exchanges like MCX, NCDEX, and so on, which were, all of us know, which were established in 2002, 2003, at the ground level, still many things remain to be changed for better. Okay. The physical sale of agricultural commodities or agricultural crops, till recently was still completely administered by the states. And each state has its own regulation, all of us know. And within each state, there were several market areas. And each area had its own APMC. What is APMC? Agricultural Produce Marketing Committee. And the APMC used to dictate its own regulations, its own fees, and so on. So at the ground level, we have the states regulation, and within each states different areas, each regulated by an APMC, which again had its own fees, its own regulations. So this structure tends to complicate the free flow of commodities. I mean, directly from the farmer, people weren't getting the commodities. They aren't getting the commodities. Even now, it is still improving, but a lot of things, a lot of legislations have been passed to that effect. Okay, so what happens is handling of commodities at multiple levels also attracts multiple mandi charges. So at different levels you have to pay the fees, and so what happens, net result, all the costs are embedded into the agricultural products and the consumer lands up paying. So the farmer is not benefiting anything out of all this, and the consumer is affected on the other side. So with so many intermediaries, the costs are getting escalated. So the biggest bottlenecks that were found so far, especially for agricultural commodities, were their storage, then logistics. Storage is where to store once the produce is ready for between production and consumption. Then logistics like transportation, then finance. So all these were found to be some major bottlenecks which have affected harvest and post harvest crops. So what has the government done? The government has finally addressed these issues by a combination of technology, physical infrastructure and stronger regulation. So how combination of technology? So in the year 2016, the Prime Minister launched the Electronic National Agriculture Market Platform. So it's an electronic platform, and with the expectation that it will reduce transaction costs and information is also better available to the producers and the consumers. Thus with this there is better price discovery. So in a nutshell, these e-portal help farmers also command better prices for their produce by bypassing the middlemen. Okay, and support is also offered for transport for the farmers, from their place to various warehouses and so on. So following this, some of the fintech companies also introduced, the private companies, following what the government has done, the private companies also started introducing e-auctions. They saw a very good business prospect in this. And these e-auctions further contributed to transparency and fair price discovery of these agricultural commodities. Now, besides the obvious benefits that you are eliminating the middlemen as much as possible, and farmer gets a better price, consumer gets a better price. The other benefits also include faster payment to farmers, then lower prices to all, better monitoring of demand and supply. Then farmers are able to also, if there is an issue, they are able to directly reach out to people and express what they want to do. Okay, so besides e-auction, the focus was also on warehousing solutions, giving better warehousing solutions. The government has been actively incentivizing private investments in high-tech warehouses. Okay, so they have been incentivizing, and also this has become a priority sector lending. So under this is under the purview of Warehousing Development and Regulatory Authority. So a new breed of warehouses have emerged, which are scientifically crafted, and they are completely information technology enabled. And with a click of mouse, which farmer has what stock, what is not there, what is there in the warehouse, and all the other information one can get to know. So this is another major reform that was brought out. But please understand, this regulation has started only from 2016. So it is still, there is still time, before we start seeing the real results of all of this. Okay. And then finally, we all know the reform in terms of regulation. So SEBI, which carried the reputation of being very superior in terms of surveillance, risk monitoring, and enforcement mechanisms, this has been merged with FMC, or the Forward Markets Commission. So this has led to creating a more robust regulatory body for the commodity sector as well. And to tell you, SEBI has already implemented a slew of advancements in commodity market space as well. Okay. So in conclusion, we can say that looking ahead, it appears that Indian commodities market, especially the agricultural commodity segment, is definitely headed for better days. Being one of the largest producers of over 80% of agricultural produce in the world. So for most of the agricultural products in the world, India is one of the largest producers, and it includes many cash crops also. So these game-changing initiatives can propel India onto a completely different level of sustainable growth. Okay, students. So with this, in the next class, I will be sharing the first set of assignments. So in all, I'm supposed to give you 5 assignments. So I'll be giving assignments which are focused on commodity markets. At least 4 of them will be from commodity market section only. And we will also look into the topics, like the depositories. I think that is left out in stock market. So that is something I'll cover, and we'll touch upon other topics also which you want me to relook. But we'll also start focusing on assignments starting next lecture. Okay, students, thank you so much.